It's astonishing. People will spend $1,200 on a car payments, and then they'll argue with me about, I don't want to spend three, four, 500 for long-term care benefits. I guarantee you the car is going to wear out, and I'll guarantee you more that there's something going to happen in your warranty. And so it's a conversation. And usually my experience is the older you get, the more you have a consciousness about your mortality.
So the question that comes up, both with life insurance as well as long-term care, is I'm healthy now. If I'm paying a monthly premium, suppose I develop diabetes or some other malady, does my long-term care premium jump up because of that, or does it stay the same? Welcome to Investing for Generational Wealth. I'm John Live from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with you, we're investing in over 1,000 multifamily apartments under renovation, over 500 single-family renovations under development, more than 350,000 square foot of industrial real estate, 700,000 of private loans, and we've expanded into other asset classes such as oil and gas ventures with the end goal of helping customers, clients just like you, create diversified, balanced portfolios. Before we begin, a quick disclaimer, as always, we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorney before making those investments. I'm your host again, John Lai, and welcome to today's episode, Creating a Sustainable Financial Plan for Care, What to Consider and What to Avoid. And our guest today is Raymond Lavine. And Raymond is the founder of Lavine LTC Benefits. And as the title states, we're talking about long-term care planning that protects both your health and your wealth with personal and professional experience in extended care planning. Raymond will guide us through key considerations and common mistakes to avoid when preparing for the future. What we'll learn today, and we'll get into this, why care planning or caregiving benefits are essential to our overall financial plan, the risks of delaying care planning and how to avoid them, and then just LTC insurance, how it can protect our estate and loved ones. Raymond is a U.S. Army veteran. Thank you for your service, Raymond. And a lifelong learner. He's appeared on TV shows like Moving America Forward and co-authored books. And so, Raymond, for those who don't know your journey, could you give our audience a brief history of how you got to where you are today?
Thank you for having me as a guest on your podcast, John. My background is varied, but most of it has been in some form of financial services, whether it's been mortgage banking, commercial banking, but I've also been involved in life insurance. And also for a while, I was doing property management. But for the last 15 years, I've been involved with long-term care benefits. And it's a form of insurance that provides caregiving and either at home or in a care center. So that's been mostly my background. As you say, I was in the U.S. Army. I was in Vietnam. I was with the 173rd Airborne Brigade, also known as a jumper. But I didn't jump. I may have jumped to conclusions, but I sure didn't, fortunately, didn't have to jump in Vietnam. And then last year, I wrote a book with Chris Voss, and I've been very involved in negotiating, learning how to be a better negotiator, which actually has helped me to become, if you really want to put a title on me, a better salesperson, a better communicator, where I'm not just using all this people think of manipulative sales stuff into really being a better negotiator. And I'm going to be interviewed by Chris in September. And I'm in a way, you were telling me you're a UCLA graduate. I'm a USC graduate. The point is, I really would have liked if in school they had given courses on negotiating, not just negotiating theory, but really the practical part of negotiating. Besides my enjoyment of reading history, this is where I've been spending my intellectual time, is really how to become a better negotiator. Or effective negotiator. Not better, but an effective negotiator.
Yes. I'm curious to know, coming back as a U.S. veteran, how did you get into the world of long-term care? Or I know it's a transition from finance.
Long-term care benefits generally is later in life thinking and benefit. you're not going to think about it. They're not going to teach it in high school. They're not going to teach it in college. And so you sort of learn about, incrementally in your life. But it used to be the plans you could be in your teens or in your early 20s and get a plan. But it's really focused more on if you're usually you begin to think about it in your 40s, but some people do it earlier. So a lot of agents or long-term care people or financial planners or wealth advisors, if they bring it up at all, that's been an issue is you can't know about something unless somebody you read about it or somebody
Right.
says think about it. Usually it's sort of because either there's usually three ways that how somebody becomes aware of it. The first way is because somebody has a caregiving issue, a parent, a friend, somebody in your family, and that's when one way you begin to think about it. The second way is an advisor or somebody says, look into this, or they sell it, or they offer it. Or the third way is there are people that do read and they become aware of it. I call that, in some ways, sort of the unconscious becomes the conscious. And that is an issue. There is that there are a lot of people, and we were talking about this before, of your podcast listeners and your clients, is that you're so busy doing other things in your life. You're unconscious of your own planning, your own issues, other than you know that you need health insurance. Know that you do.
Right.
And the reason you do is either your company provides it or you just know. But caregiving is something where it's invisible to many people until it becomes visible. And I always say that if you want to see how visible it is, anytime you're in public, anytime, no matter where you are, unless you're in a community, you have people that are 50 or less, you're going to see people that have mobility issues. You just have to recognize it. But if you really want to know, if you have to go to urgent care, if you have to go to the hospital, if you have to go to the emergency room, trust me, you're going to see hundreds, if not thousands of people that have some care issue. So this is where, in some ways it's interesting, in some ways it's aspirating to me. How do I get people? What do we need to say to people where you don't have to like it? You don't have to like the idea of thinking about getting Annie, but we're always planning. You're planning our businesses, we're planning our lives, we're planning vacations. And one of the things that I think is important, and I have to say this for myself too. I try to live in an absolute bubble. I do have to want to live in the real world bubble, is that things are going to happen to you. If you don't like the idea of long-term care benefit or the word of it, think of it as warranty insurance.
Mm-hmm.
And the warranty is that you're going to get old, if you're lucky, and you're going to start to wear out. And so what this is, it's money that will pay for your caregiving, whether at home or in a care center. And the usual thing, I'll get out all the usual stuff, is that people say, I don't need it now. I'm at whatever age. I'll never need it. But look, I don't need a flat tire, but it's going to happen, or my something's going to happen. So I have AAA now, or some other form, so that I can have somebody that can come and help me out at an unexpected situation. So caregiving, it comes in three flavors. It comes by illness, it comes by accident, or it could be by cognitive. Actually, there's a fourth, there's frailty. You just get old, maybe not a lot of things happening, but there are a lot of daily activities that you can't do yourself, and you need somebody to help you. Don't believe me? I started off life as a baby. Before I was a child, I was a baby, and my parents had to take care of me. The things that they had to do. Well, at the other end, there's similar things. The only difference is that you do have maturity, hopefully, and you do have adult rights. And so you can be more feisty and won't be more difficult than if you're a baby or a child. But the point is that these things are going to happen to you, and you got to have a plan. Tell me any business that doesn't have a business plan. Tell me any business that doesn't have to worry about funding for the business. Tell me about any business that says, I need employees, I need people to help me. Tell me any business that say, I don't need advice. These are the things that are good. But what I do is I provide the money so that you can make these choices. You are a business. A human being is a business. You have bank accounts, you have debts, you got credit cards. You are a business. And these are things that will happen to you. You're going to need eventually to hire people to help you with your daily activities. And that's what this kind of insurance does. Now, the other thing is to say, look, I make 100,000 a year. I make $1 million a year. I make $5 million a year. I don't need this stuff. I don't need this. It's a waste of money. It's a bad investment. And I would argue, look, if you're making 50 million a year, do you need it? Probably not. However, other people that buy lots of life insurance, reason is they're not doing it because they love to buy life insurance. They're doing it because it provides liquidity and it's tax free. So you do it not tax. You can call it tax avoidance, but tax deference, or it's a way of funding, your funding your estate tax, or it provides liquidity, and there are tax benefits, and in that way it's a good investment. The reason I think that owning long-term care benefits is because you love it. It's because it's a good investment where wherever your money is going, whether it's passive income or it's regular income, there's a tax to it, and it has to generate all the time. And when you need caregiving, you're making payments all the time. And so you have to decide, do you want a tax-free benefit or you want to sell assets, or in your regular income, it's going to be taxed. There is nothing in the tax code that says that if you have that if you're paying for care that you don't get a tax deduction. So these are reasons to do it. Now, another downside thing is people will say, I may not need it for 20, 25 years. I'll wait till the end. I'll do it. You don't buy car insurance when you've been in an accident. You don't wait like the Palisades fire. You don't wait. You do it before. And the earlier you do it, the sooner you do it. It's the same with the investing. If you want to get wealthy, if you want to have money, you got to do it as soon as possible, and you got to give it time. You have to give investment time. And it's the same with owning a long-term care plan. If you get a time, whatever you say, oh, it costs too much. When time a mortgage, the longer you own the home and the more money you make, what seemed difficult and not pleasant, you don't worry about it as much. It becomes less. So that's why it's a good deal, because then whatever money you need to use for your lifestyle, or promises you made for your estate, or promises you made because you want to fund something at UCLA, these are things that you can do, and you don't have to worry about saying, look, this is costing me $10,000 a month. And I'll give you a personal example. My mother was very affluent, very affluent. And she was making well over $1 million a year in income, passive income, all kinds of stuff. And she owned a long-term care plan, and she was an estate planning attorney. So this is somebody that is knowledgeable about estates. And I asked her, I said, why did you want plans before I was in the business? She said, nobody has that much money to pay for lifestyle and caregiving. And she died a couple of years ago. Actually, today, she died 2 years ago. She was 103. And she was on caregiving for 18 years, and it was gradual. Eventually, it was 24 hours a day, 7 days a week. Now, if you're in West Los Angeles, she lived actually near UCLA, along Wilshire Boulevard. She needed care 24 hours a day, 7 days a week in Los Angeles. So forget the math. Just do the arithmetic. 24 times 7 times maybe $50 an hour. And that's a lot of money each month to pay for full-time caregiving.
Yeah, I suspect that people who don't believe that they need long-term care believe that, hey, I'm either young and I'll bounce back, or like I'm fairly indestructible. And so that's the perspective that they take. And that's why they don't think they need long-term. Or they feel like they have enough.
Here's another thing. You're riding your bicycle. You ride a bike, and you really like bicycle, and then you get hit by a car, or you fall over, and then you might be a year or 6 months, recuperating. That doesn't mean maybe you can maybe still work, or you can do things on your computer, things you can work, but there may be a lot of daily activities that you can't do, that you need somebody to help you. Now, if you have a spouse or partner, then maybe they can help certain times of the day. But if they have their career, are they willing to give it up? Can they give it up? So you may need to hire for certain hours of the day to help you with daily activities, be cooking, cleaning, transitioning, taking you to the doctor. And to give you a personal example, my father was a lawyer. My parents were both lawyers. They actually met at USC Law School in the 40s. Anyway, the point is that there were three times in his life where he had very long-term care needs. One is he was in a car accident and broke his back. The second time, because of his back, he fell off a horse and broke his hip and his arm, and he was immobilized for a year. And he was in his, I guess he was in his 60s. He was in his 60s when that happened for a year. These were a very long period of time where caregiving benefits would have been helpful because my mother, she had her career too. So it isn't for me theoretical or it might happen. These things do happen. It happened to my wife's parents too. Same kind of situation. So again, this is part of, if you think of yourself and your family as a business, you got to run it as a business to say, what resources do I have? What people do I have to help me if in the chance I need caregiving? Another person, like when you make the worst decisions is when you're in a crisis or you're angry or you're tired. I make unbelievably bad decisions when I'm feeling pressured or I'm just overwhelmed. Good news is I have a wonderful partner, Barbara, who, when I'm in meltdown, is a terrific advocate. And hopefully you're the people or your podcast guests that, it's helpful to have an advocate, but it's also helpful to have a plan. And planning it isn't just, even whether you alone, even if you have a will, you have a trust, you have all power of attorney and all that stuff. There are a lot of things you've got to be organized about it too. You got to make sure that it's either manually in folders people can find and people know about it, or it's digital. Because this is when you're at your worst and you're at your most vulnerable. And if I know something about Americans, because I've been here a long time, is that Americans don't like to feel frustrated. And they don't like to feel that they're especially out of control, that they themselves can't make decisions. Americans like to make decisions. And the worst time that the most vulnerable time when you can't make decisions is if you're not organized and people don't know where your prescription and your medical records and things like that. But it's also, you feel vulnerable saying, where am I going to get the money?
So a couple of thoughts on that. One is, it sounds like it's never too early to think about long-term care. And I would imagine very similar to a life insurance. The earlier you get it, the cheaper it is. And then the other question is, are there other best practices in procuring long-term care?
There are a number of ways that you can get it. If money is an issue, money is always an issue. There are a number of things that you can do. You can do reverse mortgages if you have equity in your home and you're over 60. There are ways you can do it. The other way that you can fund it is if you own life insurance, cash value life insurance, even term insurance, and a certain amount of it you don't need, you can transfer. I'll give you a financial thing. Never cancel your insurance, your life insurance. Never. What you even say have terminal is either transfer it over to a long-term care plan or use the cash value to fund something else, but don't cancel it because it's an asset. Life insurance is an asset, and
Right.
types of long-term care benefits are an asset. And you got to be careful. What assets are you selling, or can you transfer it? So you can, and there are other ways you can find it. You can use, say, health services accounts to pay for your premiums. The other thing is that you could have your company that can pay for it. And you can have benefits through your work, long-term care benefits. You could have as an employee benefit. So there are a number. The other one. If let's say you have no health or your health is pretty bad, if you have an annuity, a non-qualified annuity, or you have life insurance, you can transfer it over tax-free to a annuity long-term care account, and you can get your benefits right away. And the benefits you receive aren't taxable. Now let's assume that you still have money in the account and you die. Well, but then the money that you transfer doesn't go away, because that's always something people, if I do this, I'll lose it all. No, you don't. It will transfer to your beneficiary tax-free. So I go back to it's a good investment if it's set up properly. It will do. If it doesn't take away the caregiving, then you can leave money to your beneficiary. And beneficiaries are always happy to have money. I've read about that many times. Beneficiaries like money.
So you can, very similar to life insurance, you can set up a long-term care disability to generate cash for you as well.
I'm not sure of your question. Ask your
Yeah,
question.
sorry, let me just get back to my headset. Can you hear me now?
Yes, I can hear you.
Okay. My question was very much like life insurance. There are ways to set up long-term care insurance disability to transfer benefits to your loved ones as well, or is it primarily used to cover your expenses related to medical?
Okay, first of all, it's not disability. Disability, you are disabled, but it's a
Oh, I
different
see.
because disability protects your income. Disability insurance protects your income, where
Got
long
it.
provides benefits. Here's nothing I actually have, since you bring it up. You can be on disability insurance and have long-term care, where one will cover your income, and you can still work. The long-term care benefits will pay just as long as you prove that you have activities of daily living. So you can use both, one for you to protect your income or your income, and the other to pay for your caregiving services. So you can have both. Now, there are certain plans like traditional plans, which the original plans they used to call it care center insurance, nursing home insurance. I couldn't last nursing home insurance, but it's transition where it's now more people who want to stay at home. Again, if you're organized, so the traditional insurance, that is an expense. It's not an asset. It's like a car insurance. If you never use it, then when you die, the insurance goes to money heaven. But there's still good reason. I mean, I own a traditional plan. But if you own there are different forms of insurance where, yes, if you never use it or you don't use it all, then the balance will go to your beneficiary. If I've answered your question.
Yeah, I mean, I was most interested in understanding whether it's like a whole life insurance where there is a income
There,
portion of it.
that's right. In hybrid, yes, there is cash value. They're different forms of. But to keep it simple, yes, it is cash value life insurance that has a long-term care benefit in it, and there are various forms of that. There's short-term care benefits that actually has very reasonable premiums. So some people will say, for whatever my conscience won't let me get a long-term care plan. I don't care, but it might be maybe a 1 or 2 year, and it costs you $150 a month. Are you willing to do it? Yeah, I'm willing to do that. Look, I can get you a plan for $95 a month. It's a subscription plan. You can get it. It's only for home. You can only get it for home. You can't get it for nursing or cognitive care for $95 a month. Actually, it goes up to different levels, but what you can buy are hours, and it's a subscription service. So long as you don't immediately you can get it at any age, and it's $95 a month to begin.
In that situation, why would someone want like what situations would there be that someone needs a short duration of long-term care insurance?
You get money. What can they afford? It could be also health assessment. They're more lenient with health assessment. So you could have more health issues and you're more likely to get guaranteed, but you're more likely to get it. And it's about money. It's about premium. They say, look, based on my lifestyle or something, I really can't afford to do that, or your health, or just what you believe.
As a general guideline, what is, if I'm thinking about long-term care insurance, how much should I get? I have guidelines for whole life or term life, so I understand that perspective. But long-term care, I don't really know what will happen. I know like what type of care I would need depending on if I'm fully disabled, partially disabled. Is there any guidelines on that?
Well, there are a number of things. First of all, for your listeners, I have an artificial intelligence software where people can put in information and they can get an idea based on their lifestyle, what when they might die, and it will also show them the cost of care, what the cost of care is. Now, the other things that you consider, some of it is just you have to. I'm trying you have to think about what the life expectancy in your family. And people know Uncle Ned died at 92, Aunt Martha died at 57. So you get an idea of the lifestyle and the life expectancy, usually of your immediate family. And some of it might be personal experience. Somebody said, look, Uncle Ed had dementia for 10 years and they had to sell the house and it was just all, and Martha had, it was just an economic nightmare. And some people will be more cautious and they'll say, look, if there is dementia or there are issues, longer may be better. If you can afford, again, based on premium, based on how either I or other can design it. And also, again, your age and your health. So, if you're 72, can I get you long-term care? Yes. However, if you have diabetes and you're overweight and you've had a stroke or you've had some heart issues or you've got neurological, that's all that's different. When somebody has neurological, if they have these, then it makes it more difficult. That's where there are annuity type plans. But again, it's having funds in order to transfer money that you can get these plans. It's family history. It's your health. It's certainly money. Forgive me, it's money. And what are you willing to risk? Now, for example, I invest, but I'm not a gambler. I don't gamble. I don't enjoy it. So I'm okay to lose something. I'm just not okay to lose a lot or everything. These are the risks. These are the things that you have to consider. I was thinking about it too. How many people do you know when you get into a car accident say, I'm so happy I have a high deductible? If you have your warranty, you say, gee, I wish I didn't have that warranty. What a waste. You always think of, I wish I had owned more. I wish I had more because of what it cost. And so some of it is just how you feel about it. Some of it is your health assessment. Some of it, what can you afford? But look, there are other things too. You can have family that can help you. You can have other resources. You don't need to fully fund it. But my belief or my feeling is you look at your family history, your life expectancy, what assets you have, what are you willing to risk? And there's something, all right, so you don't buy the $85,000 truck. Maybe you get previously owed. It's astonishing. People will spend $1,200 on a car payments. And then they'll argue with me about, I don't want to spend $300, $400, $500 for long-term care benefits. I guarantee you the car is going to wear out, and I'll guarantee you more that there's something going to happen in your warranty. And so it's a conversation. And usually my experience is the older you get, the more you have a consciousness about your mortality.
So the question that comes up both with life insurance as well as long-term care is, I'm healthy now. If I'm paying a monthly premium, suppose I develop diabetes or some other malady, does my long-term care premium jump up because of that, or does it stay the same?
No, it's not like car insurance. Right. If you build up the points, I know if you build up no. It's once you own it, then whatever your health is, it's the policy has been approved. You own it as long as you pay the premiums. Now, with traditional care, there was a long period where premiums were rising, and that upset people. But my homeowner's insurance hasn't gone down; it's gone up. My car insurance has gone, but that issue has been mostly resolved. That they've gotten better at pricing. So traditional plans aren't exposed as much to premium increases. If you own a hybrid plan, if you own an annuity, once you own it, no matter what your health is after that, premiums are never affected. It's guaranteed.
You might have gone over this, but could you explain what a hybrid plan is?
Okay, a hybrid plan is a life insurance that has a long-term care rider to it, and there are a variety of long-term care plans. The good ones it's designed where, just like a traditional, where you have how much per month, how long, and it also has inflation benefits. And some used to be that a lot of these plans had lifetime, and that went away for a while. And now more plans are coming back. You can even get lifetime. Where is that helpful? If you have a cognitive issue, look at Ronald Reagan, or he was over 10 years that he needed cognitive care. Again, it's a combination of life insurance with long-term care benefits. Now, there are plans that's called critical care. People buy a life insurance policy. It has long-term care benefits, but you got to be careful how it's written and also how you qualify, because with a regular long-term care plan, and I'm getting too technical and I shouldn't, I feel badly about it, but I'll get over it. It has to do with how you qualify. But if you qualify for activities of daily living, it's two out of 6. But if it's critical care, then you have to prove that you're never going to get well. These are kinds of things. People own plans because somebody says, "Oh, it's this," and it sounds good. You have to be careful what you're buying and understand what it is. Now, the way I do it is I summarize it for my clients because they're going to forget. And I'll own something, and unless I keep records, I forget what it's about. And you got to keep, so I summarize it to say, this is what it is. These are the numbers you need to call. Have your records both digitally and in written form so that you could find it, that you can locate it. Because that's the first thing, everybody wants to know whenever something happens is, where's my insurance plan? What's the number? And hopefully hopefully they will approve. And so these are things that I work to help people to have that kind of plan. They know what they're getting, and it's written. So when you forget, you can look at it and say, "Oh yeah, Raymond memorized these plans, and this is what it will do."
What are some of the things that when you got into long-term care really surprised you? And in a similar vein, like what are some gotchas with long-term care?
Gotchas of long-term care. And I read about this, or I talk to people. Long-term care benefits is about activities of daily living. And what it means is it's not that you have an illness. What has the illness done to you in order to qualify? Because people will say, well, I have asthma, or maybe that's not a good example. I hurt myself. I fell down, or I had COVID, or I had something which, let's say you need 3 weeks of recovery. And I say, I have a long-term care plan. I'll just apply and get the coverage. You're not going to qualify yet. It has to be over 90 days. And what people think is just because you have an illness or an accident or frailty, that will qualify you. It has to be something where the doctor says it's for a long period of time. That's why they call it long-term care. It's longer term, and it's something of which it's what has happened that you need caregiving assistance, and that's why they call it activity. It's eating, bathing, transitioning. So and there are things that people can do. They can make sure that their doctor does it, or they can call me, or there are services that will say, all right, we're going to help you have the information together so that when it's sent to the insurance carrier, that they have the records to say, yeah, we'll approve it. But it does upset people. And then they'll think, oh, the insurance company is horrible, and all they want to do is deny the claim. There may be companies, and there have been situations that happen, but in most situations, it's because people forget that it's not that you have an illness or an accident or frailty or even cognitive, is how is it affecting your daily activities, where to say you're at that point where you need caregiving. And that's then I think an area that most people get immediately upset. So they'll write on social media how awful or how irresponsible the carriers are in paying. And because in most situations they've applied, but they forgot or they didn't understand that it has to be, you have activities of daily living. I'm doing the insurance stuffy, but it's how are you living your life? What daily activity? What's happened where things that you can't do? You can't get out of bed, so you need somebody to help you. You need help in bathing. You need somebody to help you prepare your meal. Or the big one is having people that can take you to the doctor and making appointments. And if family members aren't there, you have hopefully a trusted caregiver that can help you keep your finances. And you got to be careful about all those things too. The people you're hiring are the honorable, but it could be people that are coming in to help you with your physical therapy, or because there are medical things that is coming in, and it's an RN that might cost you $150, $200 for a visit. And these expenses add up, but there are things of which, if you have dialysis or the things that comes in, it needs to help you with your bandages, or because you have IVs, or these are things of which you need. You can, a lot of times you get home services rather than have to go to your physician. This is what people tell me, or things that I read, how much time caregivers are just in caregiving, but just doing all the administrative things you need to do, the phone calls, the appointments, keeping records of medication that you need. And it's a lot of work to be a caregiver, and not something that I have. It's one of the reasons I'm happy I own long-term care benefits. It's not because I don't love my wife. It's not because I don't care about my wife. I just don't want to be a caregiver. And there are things that obviously I will help, but to do a lot of the day-to-day things, It isn't something that I want to do, and I don't think I'm good at it.
Yeah. And as you say, 90 days is that transitional point. Before 90 days, your health benefits will kick in. And then if your diagnosis is that you need some type of long-term care.
It's waiting. I know I've been around. They call it elimination. I call it waiting period. I don't like. I think the elimination period is a misunderstood word. However, there are plans depending on that. Again, it might be extra cost, but somebody might say it's worth it. You can get 0-day waiting, where you just say once you're approved, and even if there's been a delay, that whatever services that you use, you will get an eventual reimbursement for things that you paid. And again, it's a financial thing too. Some people say, look, I've got enough money or funds that if the premiums, I'll wait 90 days or 6 months. There are other people who might say, oh, look, I don't want to take that risk. It's like in car insurance. Do you want a high deductible or low deductible? Health insurance, you want a high deductible, low deductible? What do you want comprehensive? What things do you want? And these are considerations. And again, when you need it, it's always, oh, I wish I would have the low deductible. I wish I had the shorter waiting period. But these are economic, or I should say, these are financial decisions you need to make. Now, one of the other things too is that you can stack it. What I mean by stacking, I'm not talking about pancakes. I'm talking about you could own a plan. And let's say, and depending on the state you live, sometimes they're really good plans. Sometimes you might say, as time goes on, I'm getting older. My health is okay, but I don't really think I have enough. I can help you with a subscription plan. I can help you with a short-term care plan so that you can stack it and you can use it in different ways depending on your health situation. So it isn't always just one and done. It isn't always, I wish I'd done. Sometimes there are ways that even if you're older, even if you have more health issues, maybe there are things that we can do to stack it so that you can have the kind of very long-term care plan. Think of it this way. You have the sports car, and then you have the SUV. You have a vehicle based on what activities, what things you want to do. Or you have your RV. So a lot of people have two, 3, 4 vehicles, different things for your lifestyle.
Got it. Okay. That's a lot of great information. And thank you very much for that today. For those that are interested in long-term care, how can they find out more information and maybe contact you to find out more?
Sure. www.lavineltcins.com. That's lavineltcins.com. You can also find me on social media, Raymond Lavine, Lavine. And also, I'm happy to, if our listeners get there's no expense to it. They complete the information. I'll give them an idea about their life expectancy and what long-term care benefits. Also, if they want a copy of my book, they can get it. It's not an audio. It's not an audio book, but it's like a Kindle book that you can get. It's called Tactical Empathy in Business. And I'm happy to anybody that wants a free copy to offer them a copy of my book about tactical empathy.
That's great. Thank you for that. And we'll include all that information in the description of this podcast and webinar as well. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue providing you best educational content. Thanks, everyone. And until next time, keep listening for generational wealth and investing for generational wealth.